The best time to buy property is probably when my dad did in 1960. He paid £1,600 for his first house.
This sort of exodus of overseas landlords leaving the market is another benefit.
Whether it's Trump, Truss, wars, conflicts, Brexit, doesn't really matter. No one says, oh, Brexit, then I better move out of my apartment.
It's not often that we're sat in the same room, in the same continent, let alone country.
It's very nice.
So we thought we would discuss a little bit about the market and what we're both experiencing at the moment. We share some parallels between our different markets. Obviously, I'm focused predominantly on overseas. You're UK and a bit of
UK and Europe, yes, it's becoming a larger market for us, which is good. And I think, obviously from talking to you, I think we all have the same challenges, don't we, in terms of what the customers are looking to do.
Exactly. Well, there's a couple of things that vary slightly between our markets. One of those sort of leads me to a first question, which is about interest rates. And look, we've seen it. I guess we've felt the pain of that a little bit more overseas. The options for mortgages when you're not based in the UK, the interest rates tend to be a little bit higher. But having said that, with the Bank of England increasing their base rates over the last couple of years, it's now come down a bit, which is great. But how have you found that with interest rates being higher?
Yeah, I mean, when you've had historical lows and you're up to sort of 4s and 5s, maybe a little bit more, then, yeah, people look at those headline figures. I'm old enough, and I remember back in the day, 15% mortgage rates. I still got some of those properties now. It's still viable. It was still viable then. And there are some good products out there that will... you can fix the rates. I've done something similar. I was on a very high rate, and I've fixed the rate now, and obviously that's a lot lower. So I'm much more cash flow positive every month.
For us as well, that we talk about historically in the UK, my parents and having interest rates of 15%, but also if we take our South Africa office, interest rates in South Africa are 11%. So even if it is 6% in the UK, it's still quite attractive. And it's also, I think, important to remember that property investment in the UK is a long-term play, and there's going to be fluctuations during a 15-year period of interest rates, and it's something that you kind of you have to accept, and you look at the bigger picture and what the sort of the upside is. I think a mistake that I see clients making is saying, "Oh, I can't invest today because it's 0.25% different."
Yeah.
It's about the longer term.
Also, I mean, who knows, in today's world, but rates are expected to drop.
Yeah, I had a client actually this week that said that they wanted to buy something that was further down the line that was completing in 2 years because they believe that the interest rates are going to come down. And so obviously when you're buying something off plan, if it's completing in 2 years, your mortgage doesn't start until the property's complete. So
exactly,
it works well.
We want to look at things like return on capital employed. So you're buying something for say £200,000, but you're only putting in £50,000.
Yeah.
Profitability is high. I did a cash flow summary for someone the other day, and the true net return after everything on the amount they were investing, because they were borrowing, was something like 12-13%. It's sort of double digit. So it's if you look at the figures and spend a bit of time on it and get the right development in the right location, then it's profitable monthly. And as you say, if you look at the JLLs, the Knight Franks, the Savills, in the key areas that we're developing in, they're talking about 23-24% capital appreciation from now, end of 25 to end of 2029. So not long to wait, really.
Yeah, and as you say, when you add leverage into it, the mortgage element makes this far more attractive, and it's something particularly, I guess, for us overseas, a lot of clients aren't aware that they can get mortgages even if they've never been to the UK, and that's and that's something that changes the whole view, I guess, of the investment, because rather than needing 200,000, you might only need 60,000.
Exactly. Your clients are operating at some of the fastest growing markets in the world. Many of them could be putting capital to work closer to home. What is it about UK property that keeps them coming back to the table? Has that sort of reason changed in recent years?
Any portfolio should be balanced. I don't think, we would never say to a client that all of your eggs should be in one basket. It shouldn't all be in UK property. It shouldn't all be in property for a start. There's obviously other asset classes that offer different levels of risk, different security. One thing that I found overseas, particularly in the GCC, particularly in the Middle East, being based here, every currency is essentially tied to the USD. So, I was speaking to a client the other day who said all of his assets are here, his salary is in USD, and so any fluctuation in the dollar is going to affect him across the board. So having a property in the UK, for all of the other benefits, it also gives you an income in GBP. It's always going to be a globally strong currency. And so to hedge the GBP as well as, having your USD income is something that's been really attractive for my investors overseas. But that's why different assets or different investments make up a good portfolio, because you don't want to be completely reliant on one currency, on one market, even within the UK. You look, I'm not going to buy everything in Birmingham. I'm going to put something in Birmingham, then I'm going to buy in Manchester, and then I'm going to buy in Derby. That's part of our advice. But certainly I think the currency play is probably the biggest thing that I've seen from my clients in this market.
Yeah, I think obviously Mark runs the South Africa office, and obviously with the political situation and inflation, and the same, we've got strong South American agents, where, as you say, it might be a little bit unstable currency. Then why would you not come to the UK? UK law, the UK is the most invested market in the world for overseas investors, and there's a reason for that.
Yeah, absolutely. It's definitely our South African office. I mean, using that as an example, the rand has obviously, as it weakens, it's obviously makes it harder for clients to buy in the UK because they're getting less bang for their buck. But the sort of the upside is greater because they have an asset in a globally strong currency, in a globally strong economy that is going to provide them security that perhaps they don't find that they're getting on the ground. But again, it's all about balance within your portfolio.
We hosted a summit in February, and the room was full of investors asking serious questions about the UK market. There's been a real shift in how that conversation feels. Are people still coming to the UK for security? What are they expecting the performance to be in UK property?
I think the expectation is something that we need to manage. I think that a lot of clients don't know what to expect. The summit you're referring to, we do every year in South Africa, so we have an office there. So we go around Durban, Johannesburg, Cape Town, and we fill the room with existing and new potential investors. And what we do is we give an update on the UK market. We give an update on what our current options are. We travel with a mortgage partner from Madewell who talks about mortgages specific to people based in South Africa. And it's always popular. And, to use that market as an example, again, from what we just said, it's security. It's knowing that I have an asset in a currency that I trust, in a market that I trust. That, we had a lot of people that were thinking that their kids are probably going to go and study in the UK. So being able to buy a property there now, not that they're necessarily going to use, because we don't know where we're going to end up at university. They might be in Manchester, they might be in London, wherever. But just to have a sort of footprint in the UK, to have an asset in the UK that's going to appreciate and work for them over that time. So that would be a kind of, I guess, one of the main reasons. The other, I guess, sort of expectation, I think, from clients overseas, and particularly through this summit, was I don't want to just save a pot of money that when I retire, I'm on countdown and I'm just sort of whittling away and chipping away at it until, wow, maybe it's not going to be there anymore. What I want is an asset, or putting my money now into an asset that's going to contribute, even when I stop working, that it's still making me a return in a currency that is globally strong. And that's been one of the biggest drivers I've seen recently. Everyone wants to retire as soon as possible, and if we can do that through property, then great.
I'm still old. I'm still going on.
Yeah, what are you, 28 now?
Yeah, late. I'm late 20s, I think it is.
When people think of UK property, the first place they think of normally is London.
Yes.
Because it's, obviously one of the most recognisable cities in the world. I think the London market's been quite well documented recently of its struggles. But we've never focused on London, have we? We've always looked at regional cities, be they second-tier cities, third-tier cities. What do you find the appetite is like from your sort of clients in terms of different locations? And are they open to these regional cities?
Yeah, like you say, particularly if someone's overseas, they think London. If you think of buying somewhere in America, you'd probably think New York. Australia, you'd probably think Sydney. So it's good to have an open mind, and the further north you go, the cheaper the price is, the better predicted capital appreciation, the higher the rental yields, and you can buy more. In London, average price in the centre of London is something like 630,000. Your net yields or gross yields are around 3%. So if you look at it purely on the maths, not really where you'd want to go. Now, we do sell a little bit of London stuff, or we've got developers that we work with because someone might want a trophy asset, or someone wants to live there.
Yeah,
it's fine.
Or their children are going to university there.
No problem at all.
Predominantly the central London market that's really been hit. There's places in Notting Hill and Knightsbridge and Chelsea that people, they can't sell them for the price that they bought 10 years ago. It's been stagnant, really. Yeah. So when we look at investment for our clients, why do we look at these regional cities? Well, as you said, A, the capital value is lower. So rather than 650,000, you're paying 200,000.
Yeah.
B, the fact that you can get a 6-7% rental yield versus a 2-3% rental yield is so important, because as we talked about with a mortgage, all we care about from our investment, when we look at it from a personal opinion, if I'm talking about with my investor hat on, is that my rental is paying off my mortgage. And if I have a bit of surplus, £200 or so in my first year, then I'm happy, as long as I'm not having to put my hand in my pocket.
Exactly.
And that's what London will never give you, because your interest rate, it's not going to compensate enough. The rent's not going to compensate enough for the interest that you need to pay.
And there's such a shortage of property in the UK anyway. And with all these regenerations, rail links, tram links, motorways, airport, it's just usually something that will suit an investor depending on their cash position and time frame.
I don't think people understand the gravity of how bad the housing crisis in the UK is. I mean, to put it into context, the government have told us we need to build 320,000 homes a year.
Yeah.
The last time we did that was in the 70s.
Yeah.
That's how far behind. So it's compounding each year. We're 1.8 million homes short since 2017. This is getting worse and worse. And so it's simple economics. You have heightened demand because we're a growing population, a small island, millions of people, and just not enough homes. So what was it, the BBC the other day saying that there's 25 people viewing one home at the moment. And so what does that bring us on to? Void periods.
Yes.
So one thing that you worry about as an investor is my property going to be empty and I'm going to have to pay my mortgage out of my own pocket? That's something that we want to avoid. And that's why the UK is so popular, because you rent properties so easily.
Yeah.
I think the biggest void period I've had in my properties is 3 days.
Yeah.
And and that's not specific to my development. It's just the way that the market is because of this lack of supply. I mean, before we go on to the next point, actually, with government changes, when we look at our areas that we offer. So if you look across our portfolio now, you do have some London, because we look at the periphery areas that lower values. We look at sort of good connectivity into the centre. And then, as you say, we do have central London for clients that want something for their children or to use themselves. But we're led by data. And when we look at the data from your big PLCs, JLL, Knight Frank, Savills, we always look at their reports. Number 1 and 2 in the UK now, Birmingham and Manchester.
Yeah.
Birmingham capital growth and rental yield is number 1, 22%, 24%, and Manchester not far behind. So in our portfolio, we are sort of weighted towards these second and third tier cities. Birmingham, we have various great offerings within the city centre. We've got Manchester, we've got Leeds, Derby. These second and third tier cities is very much our focus.
Yeah, low price point, good rental yields. And we've got some developments that you can the lease will allow short-term let. Costs can be higher, but it doesn't really matter, because your net, it doesn't matter really about your gross, it's your net. What are you making at the end of the month? So the nets can be really good on that. And we've got sort of some other purpose-built developments that give like an assured rental return over a fixed period. So there's kind of something, that's a bit corny, but there's something for everyone, really.
Yeah, agreed. And that's our job, I guess, to provide that within our portfolios. So lastly, I mean, on the government changes, we've seen Renters Reform Bill, we've seen stamp duty changes. What would your advice be to a client that says, well, it is now the right time?
Yeah, I think the best time to buy property is probably when my dad did in 1960, but we can't go back in time. He paid £1,600 for his first house. His mortgage was £1 and a shilling per month. He's still got that today. It's 10 more, a million times the value. So looking at historical stuff, looking at current stuff, and looking at the research partners that we work with, you've still got strong capital appreciation. So the best time to buy is always today, really. It's always straight away. We used to say probably a year, 2 years, an average tenant would stay. Rental Reform Act has only just started. Listening and speaking to the local agents, they think people are going to stay a lot longer, 2.5 years.
Yeah, I think to touch on the Renters Reform Bill as well, because that scared a lot of landlords. But when you look at the actual details of what it entails, it's making the whole market more professional.
Yeah.
It's protecting both the tenant and the landlord, that you have rights to be able to remove the tenant if they're in rent arrears or there's antisocial behaviour. There's Section 21, which they abolish, is what scared people, but there's been additions to Section 8, where, again, as a landlord, you have
more protection.
You have more
rights,
protection. And so this sort of exodus of overseas landlords or landlords leaving the market is another benefit. If you stick in the market now, that supply and demand imbalance is bad enough. But now with landlords leaving, there's real opportunity there. And for for reasons that perhaps aren't as drastic as some thought.
I think people would expect to have a rental price increase, and why wouldn't you? Because the supply is limited, the demand is there. There's a benefit as well that I've certainly seen or will see. You can put your rent up maximum of 10% a year. I know other landlords say, "Oh, I get £10 more. I'm going to kick them out and get someone else in." I never put my rent up. I don't know about you. I'm quite a soft landlord. I've had stuff that's gone up where people have left. They've been in 4 or 5 years, not put the rent up. I got £400 or £500 a month more. So I think that'll help. And we're seeing, or the agents are saying, people are treating it more like home. I've had good tenants in, and they'll paint and decorate and put new flooring in, even pay for washing machines, and not even come to me because we sort of looked after them. I think it's there. There's a little bit more legislation. This is where you need a good local letting agent.
Yeah, and then when it comes on to the stamp duty changes, I was speaking to a client yesterday about this. When you own a property in the UK, let's say you want to hold it for 15, 20 years, that's what we'd always recommend. Property in the UK isn't something you buy and flip in 3 years and expect to make double your return. Yeah. It's just not possible. If I own a property for 20 years, I'm going to have 4 different governments, different leaders, different tax changes. I cannot predict everything that's going to happen over that period. And so, as you said earlier, it's about your time within the market as opposed to timing of it. What the market shows us is every 12 to 15 years, property prices double.
Yeah.
And that happens whether you start today or you started 10 years ago, you started 5 years. So, the biggest regret that I've seen from clients having lived overseas for 10 years is I should have just started it earlier and I shouldn't have tried to time it.
Yeah.
And don't get me wrong, it's got to make sense. It can't be something that's going to keep you up at night. It's got to be financially viable and comfortable. Yeah. Otherwise, don't do it. But if it is, and you're just sitting on your hands and leaving your money in your bank, that's not going to do you any favours.
Articles about sort of timing the market.
Yeah.
Is it going to drop a bit? It doesn't really matter. I bought stuff in 2007, so property crash. And that's the only time we've had a big correction. And probably prices dropped maybe 5%. It was only for a short period of time, and guess what? I've still got those properties, and they're 3 times what I paid for. And you can structure it as well. I mean, I know it sounds a little bit scary maybe for an overseas investor, but it's very easy, and we can set this up for clients, so you can make it more net cash flow positive. And that's probably where we come in as a company in terms of we can do everything with you or for you. I've got clients, and you've got clients that have never even been to the UK. It doesn't matter where they are. We're geared up with our after sales and handover and furnishings and solicitors, and it's pretty straightforward working with us.
Yeah, there's many moving parts, aren't there, to buying property in the UK, from mortgages to tax advice to rental to furniture to management. And, our job is to obviously help the clients through that, particularly for my clients that are 3,000 or 9,000 miles away from the property itself. It can be daunting on different time zones, but, our job is to handle all of that. We work more as asset managers than we do as agents. Yeah. We help the clients maximise their return. We do portfolio reviews every year, see if we can get rent increases,
exactly,
and help them realise the maximised potential of their investments.
And I think we've got a strong new business team. And for me, I'm old school. It's all about communications. And what we started doing, and I know you do the same, is with maybe client, solicitor, mortgage broker, us, is WhatsApp groups. They seem to work quite well. So everyone knows. I think transparency and communication are key because, as you said, there's a lot of moving parts. So I just think it's good to have that sort of instant communication, particularly with the different sort of time zones as well.
Yeah, exactly. Well, Andrew, it's been good to talk to you and
always a
sit
pleasure.
In the flesh. As I say, it doesn't happen often, but it seems like we tackle a lot of the same questions from clients, whether they're based in the UK or overseas. Yes. And it's great to do this and hopefully provide some value. I think at Joseph Muse, we're really conscious of providing free information to clients. We do webinars at least a couple of times a week to specific audiences, and we try and change the topics from mortgages to tax advice to whatever it might be. And so, we hope this kind of stuff is useful for anybody listening, whether they've invested or they're looking to invest. And I guess feedback's important, right? We always want to know what's going to help. So the next time that we do this, if there are any topics that people want to hear, then, we're all ears.
Yeah, I think we've covered a bit of everything. And a lot of the questions are the same, like voids, how does it work, limited company structure. So reach out. We're here to help. And maybe next time, because I've come to the Dubai office at the moment, it's about 43 degrees. So I think, Johnny, you need to come back with the team to
Birmingham. 6 degrees. Yeah.
Lovely.
All right. Thanks, Andrew.
Cheers.
Cheers, mate.